Good afternoon. Thanks so much for joining us for Milestone Market Update. My name is Matt Zimmerman. I'm the Director of Business Development at Milestone, and we are just thrilled that you guys were able to join us. We have Evan Troop, Managing Director of JP Morgan Securities with us, great partner to our company and to our clients. And just with all the concern out in the market and all the volatility recently, we thought it'd be great to welcome Evan onto this webinar and just give us his thoughts on where we're headed, what we might be able to expect. And then at the end of the market update, we will take questions. So please submit your questions on the side panel there, and we'll be happy to address those at the end of the call. And then I'll do a quick overview of Milestone and our fee deferral program, and would be happy to chat with any of you separately to go through the details of that. We'd love to work with you on some settlements that you have coming up in the future. And with that, I'll pass to you, Evan.
Sounds good, Matt. Thank you for the introduction there. So my name is Evan Troop. As it says there, I'm a managing director with JP Morgan Securities. And basically my team has two different focuses. One is on the money management side. We oversee about $9.6 billion in assets. And then we also work with institutional clients coming up with a wide array of custom and bespoke strategies to express their views. So today I'd like to just provide a quick update on the markets, kind of where we see things going. And then two, talk about why, even though our current positioning is definitely bearish in terms of where we think the S&P 500 is going to go, we still believe that now is a good time to think about putting a fee deferral into place, because ultimately there are ways to safely generate pretty nice returns out there. So with that being said, let's dive into it. So in terms of the S&P 500 performance, we've seen a rally here over the last couple of weeks. However, if we flash back to May, the index was actually flat. However, despite being flat, the underlying mechanics were actually quite weak. So if we look at 490 stocks underneath the hood, they fell on average of 4.1%, with only 10 securities rallying about 9.1%. And this was all focused within the S&P technology sector, which again was up about 9.1%. Conversely, if you look at the rest of the sectors, again, the performance was quite lackluster at best. And so this rally is all on the back of artificial intelligence hype. And while I certainly think that artificial intelligence is a game changer, I don't believe that the benefits will be fully realized until late 2024 into 2025. So just zooming out and taking a look at this graphically, you can see back in May that we kind of consolidated around that 4,100 level on the S&P 500. Then all of a sudden, over the last 3 weeks, we've seen an explosion to the upside from 4,100 up to 4,430. And I really don't think this is going to be sustainable for two reasons. One, a lot of this is coming on the back of retail buying. But then two, anytime we've seen a parabolic move like this, normally we see a pretty quick retracement. So you can see back in August of 2022, we had a massive move to the upside that gave up the gains pretty quickly. And again, that pattern looks very similar here. So ultimately, if we roll back and break through 4330 here in the coming weeks, I would fully expect us to retest that 4100 level and potentially even move forward. And so, as I mentioned, a lot of the buying has come from the retail channel. So this is a chart that comes to us from Sentiment Trader, which is a third-party service that I subscribe to. And you can see from the red line below that the retail, i.e. dumb money investors, as they like to call it, in red has constituted all the buying over the last 3 weeks, whereas institutional, which is denoted by the blue line, has been de-risking all the way through. And so in the past, as we've seen retail really step into the market, normally they have really weak hands, and ultimately if there's volatility out there, we normally see a retracement pretty quickly. Switching over to the NASDAQ, this is a metric that I like to use to fairly value the index. So this is taking a look at the NASDAQ 100 and dividing that by the Russell 2000, or the small cap index. And you can see from the chart that we are trading at valuations that we haven't seen since the 99-2000 tech bubble burst. And so again, while I think artificial intelligence is a game changer, these valuations are becoming quite stretched. You know, and we've gotten a lot of pushback on this too. I mean, a lot of our clients believe that we are in a new bull market, that these valuations are justified because, you know, semiconductors, as they're sold out there in the open market to support artificial intelligence, you know, that should prop up the tech sector. But even if we take a look at the semiconductor space, so semis are up about 25% year to date, as indicated there by the dark green line. But if you look at the dotted green line, the actual sales of semiconductors are actually down 20% year to date. So again, very frothy from a valuation perspective, and ultimately why within US domestic equities, we're simply just not constructive here. So if we look at cross asset returns, and we start off with 2022. So last year was the most challenging year for a 60% fixed income, 40% equity portfolio in almost 100 years. So if you start at the bottom of that column, emerging market equities were down 25%. The S&P 500 closed down 23% last year. Core investment grade bonds were down about 21%. And then same even with the 10-year treasury, also down 20%. The only sector last year that was up was the energy sector, which managed to actually rise 40%. So then if we look year to date, so far for 2023, the S&P 500 is actually up 11% now. I need to update this chart. Conversely, fixed income has been muted, whereas emerging market equities and then also oil, you know, has been flat to down. So then over the next 12 months, we actually believe that emerging markets are going to do quite well, and I'll get into why that is here in a minute. But then we also believe that core investment grade fixed income is back. We fully expect there to be 6 to 7% type returns over the next 12 months. And even with US treasuries, we think if you simply go out and buy a 10-year treasury, not only will you get that 3.75% yield, but then as the market starts going risk off here in the coming months, you could potentially even earn a 9 or a 10% type total return within treasuries. And you'll see here at the bottom that we're actually least constructive on the S&P 500. And that's really where I wanted to spend a lot of our time today. I know a lot of you within your personal accounts, retirement accounts, have exposure to the S&P 500. And so I wanted to share a few charts as to why we're not constructive on that index at this time. So starting from a technical perspective, if we look at the equal weight S&P 500, over the last couple of weeks, we've actually experienced what is called a death cross. And a death cross is where the 50-day moving average, which is denoted by the blue line, crosses over the 200-day moving average, which is the red line. And you can see over the last 15 years, anytime this has happened, this has resulted in anywhere between an 18 to a 35% pullback within the S&P 500. And so again, this is ultimately why I'm much more bullish on investment grade bonds as well as emerging market equities, because as money flows out of the S&P 500, ultimately I think that'll be placed within investment grade bonds. As those bonds go up in value, that'll drive rates down. Ultimately, the rates driving down will you know, cause the US dollar to weaken, which then will be bullish for emerging market equities. So that's what this looks like.
Devin, do you mind if I ask a quick question on this slide?
Yeah, go ahead.
I see that you're expecting a retracement over the next 6 months. Do you know what historically that timeline has been for that downturn after the death cross? Is it within 6 to 12 months, or is it more immediate?
Yeah, normally we see that within anywhere between 3 months to as long as 12 months. So again, kind of short or intermediate term, we would expect that pullback to be experienced.
Great, thank you.
Yep, absolutely. So that's what the market looks like from a technical perspective. I wanted to include this chart today because from a fundamental perspective, we are certainly not out of the bear market just yet. And so what this framework is a roadmap for how the economy typically responds to changes in interest rates, specifically when the Fed is raising rates. And so this is called the hope cycle. And if I could draw your attention to the top left side of the box, first, you know, normally within the first 12 months, you start to see housing start to slow down. Then over 12 to 18 months, you start to see orders slow down. From 18 to 24 months, that's when you see profits really start to take a hit within equities. That normally coincides with the bottom for that cycle within the equity market. And then from there, typically over the next 2 years, you see unemployment start to rise, and then ultimately the economy start to recover. And so right now, I think that we're currently between the O and the P in terms of the hope cycle. Excuse me, and I can empirically show you why I believe that. So what this chart is showing is the ISM services, specifically with regards to new orders. And if I could draw your attention to the white line, you can see here that orders have been coming down really quite aggressively over the last 12 months. We actually recently had one more print here this last week that was sub 50. So again, indicating that orders are slowing down, and ultimately profits here within equities are going to be short to follow, followed by a trough within the equity market. So in addition to technicals and then where we are within the cycle, I would also like to point out that there's going to be a lot of liquidity coming out of the system here within the next 6 months. So as we all saw, the debt deal recently got done here a couple of weeks ago. While we should certainly celebrate that a debt deal got done, what will have to happen now is there will need to be anywhere between 1 to 1.6 trillion issued out in new treasuries over the next 90 days. And ultimately, when new treasuries are being issued, this has the result of pulling liquidity out of the system via bank reserves to refill what is called the Treasury General Account. And we've actually never seen an issuance of this size. The last couple issuance that we saw were in the $500 billion type range. And if I could draw your attention to the pink line, you can see that the median pullback within the S&P 500 is about 15% over the next 180 days. So again, liquidity is normally a driver of risk on sentiment. If liquidity is coming out of the system, that's going to be a challenge for the equity market as a whole. And then finally, what I'd like to conclude with here for the S&P 500 is the yield curve still remains very inverted. So what this is a chart of a 1-year treasury, which is yielding 5.25%, less a 10-year treasury, which is yielding 3.75%. So you can see any single time that the yield curve has been this inverted, this has always led to a recession. And so while you have people on CNBC, Tom Lee, all the other pundits, pounding the table saying that we're in a new bull market, we would definitely exercise caution here. Again, we don't think we're quite out of the woods just yet. Again, as I mentioned, while we're certainly constructive in certain areas of the market, here specifically domestically within equities, I still think there's going to be some more pain on the horizon. We can even see this graphically. So typically at the very tail end of a market cycle, you have this blow off top, which is normally called the euphoria phase of the market. You can think of this as taking place in January of 2022. And then ultimately you see this first drawdown that ultimately leads into a complacency rally. And so you can think of this complacency rally as October of 2022 to present. And then ultimately, as investors realize that we're not out of the woods, that there's still more stress on the horizon, that's really where we see the final capitulation event, the final drawdown within the market before the market bases and a new cycle starts. And you can see this here on the previous chart. So if you look at the gray line, which is the S&P 500, you can see that. You can see the euphoria blow off top, again, that being January of 2022. Ultimately a drawdown followed by a complacency rally. And what we're really just waiting for right now is sort of that final pullback before we start the next cycle. And the same can be said too for the NASDAQ. If you look at, again, this patterning there within the chart, again, you see the euphoria top, the pullback, and then ultimately this complacency rally. So to conclude, in my opinion, the bear market is still not over. That being said, for folks that are looking to start a fee deferral today, you have the benefit of time. Normally the horizon on these is anywhere between 7 to 10 years. And there's still a lot of yield there and a lot of returns to be had. So simply just putting this into a money market fund, you're going to be generating anywhere between 5 to 5.5%. We're building out a lot of investment grade portfolios and barbelling that with emerging markets as we speak. Again, over the next 12 months, I expect investment grade bonds to return anywhere between 6 to 7%. Long dated treasuries somewhere in the vicinity of 9 to 10%. And emerging markets, again, I think there's going to be a fair number of tailwinds there, and would hope for anywhere between a 15 to 20% return over the next 12 months. So to conclude, even though we're bearish on the S&P 500 due to, again, this AI hype and then ultimately some stress that I think will remain within regional banks, plenty of opportunities out there. And so what I would recommend is again, getting this set up now, starting off with, again, very conservative type instruments. And as we see that final pullback, we'll start stepping into risk. And, my team's goal is to try to make you, anywhere between 8 to 10% type returns through an economic cycle. And so if you think about this as in terms of the rule of 72, if I'm, for round numbers, giving you a 7% type return, that means that you're doubling your money every 10 years. So again, I think this is going to be a phenomenal entry point here over the next 6 to 12 months and something to think about. And with that said, Matt, I'll turn it back over to you.
Thank you so much, Evan. That was great. I personally like the smart money versus dumb money of Main Street versus Wall Street graph, because you always hear if you're a taxi or Uber driver or your next door neighbor is giving you stock tips or telling you to go all in the market, that's usually a red flag to get out. So it's been, the conversations that we're seeing are kind of a mixed bag of 50% bullish, 50% bearish people in the industry and out of the industry. So I really appreciated the time you took and pulling this together and walking us through why you're still bearish on not just the S&P, but the NASDAQ as well. So thank you very much. We can take some questions now, if there are any questions. And while we wait for some questions to come in, I'll do a quick overview of our Milestone attorney fee deferral program. We have partnered with Evan as an investment manager and financial advisor for a lot of our attorneys that we're working with. But if you're an attorney in a mass tort personal injury space and are interested in providing for your retirement and having a guaranteed cash flow in the future, and have some settlements coming up and are interested in taking that money, deferring taxes, having the opportunity to fully invest in the market and have the growth. I think right now, seeing that we are expecting another bearish market, would make all the sense in the world to look at settlement fees coming in and defer. If you could invest towards the bottom and ride that wave up, that would make some great sense for you. But we'd love to talk to you about what our solution is, all the different components of it, and how we can provide that for you. I like to think of it as a unlimited 401k for trial attorneys. And the beauty of this too is it's not just putting this into an annuity or another product. You're able to invest it with an advisor of your choice, how about the custodian that the advisor works with. And again, if you want an introduction to Evan and his team at JP Morgan, we'd be happy to make that introduction. So please reach out to us online and let us know if you have questions or would like to have a meeting to learn more about attorney fee deferral. We have one question here for you, Evan, if you're still on. Would it be risky to start a fee deferral arrangement in this current market? I already have a 401k. Does it make sense to defer fees then?
Yeah, absolutely. So if we were looking to start a fee deferral today, we would start by having a lot of this in cash. So we'd probably be looking at about 40 to 50% of that simply sitting in cash, earning about 5%. And as I touched on earlier, we would be looking to spread the rest of that pretty much 50-50 between core fixed income and then also emerging market equities. But yeah, I think this is the perfect time to start this because you're basically getting paid to wait. So if equities continue to kind of trade around this area for the next, call it 6 to 12 months, and the recession is pushed back, yeah, again, you're going to be getting 5% just to simply sit there and wait for the time being. And again, I think the recession is on the horizon. While as I said, a lot of pundits have shifted bullish, and all of a sudden price targets are being raised across the street. I'm simply not buying it. I'm a student of history, and history is really pointing to, again, most likely a 15-20% pullback on the horizon. So, today, if you can go ahead and get that set up, get it in place, and get ready to take advantage of it, I think you're going to do quite well in the long run.
Fantastic. Thank you, Evan. I think that's a great question. I think there are a lot of different solutions. I think the one that makes the most sense is working with Evan and team, or again, your financial advisor, allowing them to make the decisions to move back into the market when that time comes. The other solution is, as an attorney, when you're getting those settlement fees, you can hold them in the QSF for a few months before actually deferring, and that could buy you some time if you weren't comfortable putting the money to work right now. But also, as Evan said in the presentation, there are some great areas to invest in this current market in the next, coming 6 to 12 months. So working with a team like his to take advantage of that and then move back into equities when the time's right would make sense. So we have one more question. How are deferred fees taxed? And I believe I'll take that one. If you're deferring attorney fees, they are either taxed as capital gains or as ordinary income, depending on how it's broken down. So what you're receiving from the settlement, however it's taxed coming out of the settlement, is how it would be taxed coming out to you, but it is distributed to you as a 1099 in your deferral, and we'll have a breakdown of capital gains and ordinary income. Evan, if you have anything else to add to that.
Yeah, no, I think you covered it right there. Obviously, this grows tax deferred until the distribution, but no, Matt, I think that's a great summary.
Great. Thank you so much for the questions. Thank you to Evan for your time today, and it'll be interesting to see what happens in the market over the next 6 to 12 months. Just hold on to the reins and get ready for the ride. But thanks for your partnership, Evan, and thanks for bringing this wisdom to our partners and our clients. Hope you guys have a wonderful afternoon, and thanks so much for your time.
Great. Thank you so much, guys.